One of the world's smartest investors who had invested in Kotak Bank near 208 rupees recently exited the stock near 1940 rupees after making 609% returns, is now betting on Yes Bank. I am talking about Sumitomo Mitsui Banking Corporation, who recently acquired 24.2% stake in Yes Bank. Now, this could be a transformative moment for Yes Bank. So, should we buy it? But at the same time, India's largest bank, SBI, is quietly selling its stake drastically. One giant is entering, the other one is exiting. So, what is the real story behind Yes Bank? Is it a golden multi-bagger in disguise, or is it a trap waiting to spring? Let us find out in this video. And to understand if we should buy Yes Bank today, you need to know about its past. But before starting in the main video, you need to know that Yes Bank is very risky as well as super rewarding company. So do not drop the video in between and make any decision. Watch the video till the end. Yes Bank started its journey back in 2004, founded by Rana Kapoor and his partner. But destiny had a twist. In 2008, his associate passed away, and from that point onwards, Rana Kapoor was the sole driving force behind Yes Bank. From 2008 to 2014, Yes Bank was on fire. It grew at a pace that shocked the entire banking industry, and one of their biggest tricks was offering a higher interest rate than everyone else, pulling in massive customer deposits and building a loyal base rapidly. Investors loved it, the stock price skyrocketed, so Yes Bank became a market darling, a superstar in the making. But then came 2014, a turning point. This was the time period when RBI started cleaning up the banking system. Remember the Nirav Modi scam? The DHFL collapse. The entire NBFC sector was dealing with stressed assets. And here is the problem. Banks lend to each other, banks lend to NBFCs, and if one major player collapses, the shockwaves spread everywhere. So RBI told all of the banks, open up your books and show us the real asset quality. And Yes Bank claimed to have 0.31% of NPAs. But when RBI dug deeper, the numbers simply did not add up. Now, most of Yes Bank's lending was going to corporate, nearly 68%, one of the highest in the industry. Now, many of these loans were high risk, poorly monitored, and given to already stressed companies. And then came the bombshell. According to CBI chart sheet, Rana Kapoor was not just giving out risky loans, he was allegedly running a full-blown nexus with DHFL. Here's how it worked. First, Yes Bank gave huge corporate loans to DHFL. Second, DHFL defaulted carefree. And third, a forensic audit found out that DHFL was simultaneously investing money in companies owned by Rana Kapoor's daughter. So money was flowing out of Yes Bank into DHFL and then quietly circling back into Kapoor-linked entities. Once this came out, it exploded into a national political issue. The news channels picked it up and the experts started questioning that how such a big bank could hide so many irregularities. And that is when panic began. The stage was set for a classic bank run crisis. Imagine this. You hear that your bank is in trouble. So what do? You rush to pull the money out. Now imagine thousands of people doing that on the same day. No bank, no matter how big, has that much cash at hand. They lend out your deposits to earn interest. When everyone came for their money at once, Yes Bank froze. The stock crashed and the government knew that if Yes Bank failed, it could trigger a domino effect, pulling down the entire Indian banking system with it. So they had to act. So in 2020, the government launched a rescue mission. It was smart and decisive. First, they imposed a moratorium. You could not withdraw more than a small amount, and this stopped the bank run in its tracks. Second, they orchestrated a forced marriage. Now RBI asked, the big banks like ICICI, SBI, and Axis Bank to invest thousands of crore rupees and buy Yes Bank shares at 10 rupees each. But here is the crucial part. All of these banks were put under a 3-year lock-in period, which means that they could not just buy at 10 rupees and sell at 15 rupees the very next day. They were forced to become long-term partners to stabilize the ship. So when you see SBI selling its stake now, are they exiting because the bank is not performing? No, they are exiting because their 3-year lock-in period is over. They have done their job, they have stabilized the bank, and now they are making a planned exit. So this is not a red flag, this is the end of a rescue mission. So this brings us to the billion rupee question. Should we start buying Yes Bank just because it is a 23 rupee stock, or because a global giant like SMBC is investing heavily? See, my answer is it's complicated. It is a yes as well as a no. And this is exactly where most of the retail investors get confused. Because when a stock sits in the gray zone, not a clear buy, not a clear avoid, you need proper research and not guesswork. And this is precisely what we do in the Rangavan Premium Plan. So whenever a stock falls into this complicated category, we analyze the fundamentals, the risk-adjusted returns, the management quality, the upcoming triggers, and whether the stock deserves to be in a serious long-term portfolio or not. So instead of getting stuck in confusion or the fear of missing out, you get crystal clear actionable guidance. Buy, add more, hold, partial sell, or book profits. And yes, you also get 2 full model portfolios for free along with swing trades and premium research reports. So if you ever feel stuck between a yes or a no, like in the case of Yes Bank, then our premium research will give you the exact clarity that you need. So for more details about Rangavan Premium, visit rangavan.finance. Okay, now let us dive deeper into the most important part, the actual yes versus no reasoning for the stock. So yes, there is actually a strong reason to be optimistic. See, the SMBC investment is not a small check. It is a transformational move. It gives Yes Bank a massive credibility boost in the eyes of the depositories, the investors, and the regulators. So fresh capital from SMBC helps the bank exactly where it was struggling, in its margins, trust, and growth momentum. Now let us have a look at the no case. See, Yes Bank has improved dramatically in the last few years. Earlier, 68% of the loans were given to big corporates, but now that exposure is down to 27%, and the retail loan book has grown from 12% to 48%. Also, the gross NPA and the net NPA have improved sharply. But here's the thing that most of the people miss. See, the bank's profitability is still a challenge. It still needs to increase its CASA ratio and significantly increase its net interest margin to that 3.5% benchmark. And that will not happen overnight. So what am I doing? See, for now, Yes Bank is on my radar, not in my portfolio. I am waiting for clear signs of turnaround in its profitability, specifically a sustained improvement in its net interest margin. And when that happens, we can see a significant upside potential in this stock. And one more thing, one should not buy the stock if they are expecting quick returns. Now, this is a stock for patient, long-term investors with high tolerance for risk. It is a potential multi-bagger comeback story, but the final chapter has not been written yet. So let me know your thoughts about Yes Bank in the comments below. And as always, this was Sanika from Rangavan Finance, where your growth is our priority. I will see you very soon in the next one. Till then, bye-bye.